What's up, guys? John here. Over 2,100 homes have been destroyed and damaged due to the massive flooding that's occurred in Maine.
The Maine seacoast also saw some major impacts from flooding.
The extremely high tides pummeled the coastal community again for the second time this week.
Over 200 homes have been ripped into the ocean. But when you hear what Progressive Insurance is doing, State Farm, and some of the biggest insurance companies in America, they're all doing the same exact thing. What is that? They're gearing up for massive rate increases nationwide in 2024 and 2025.
Home insurance costs are on the rise across the country, driven in part by weather-related disasters.
And I believe this is going to push many homeowners to the brink. They're not going to be able to absorb all these newfound costs. Well, I'm going to show you what's happening right now behind the scenes and how I think this is going to impact the overall housing market, real estate market, and the U.S. economy. Please hit the like button. Hit the like button. YouTube will share the content, educate more people about what's really going on in America's economy. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in a credit report, go to GreatCreditFast.com, click the link in the description just below this video, schedule a free strategy session. Take a look at this. So she's gone. Onlookers watch historic landmark gets washed away by flooding. State of emergency declared for coastal Maine counties impacted by flooding. Maine storms wash away iconic fishing shack, expose long-buried 1911 shipwreck on the beach. But look at how crazy this is getting. Maine coast walloped by flooding and rainfall. But 1%, that's the number, only 1% of homeowners in Maine have insurance that are going to cover them. Think about the amount of wealth that has been generated through hard work, really just building out businesses, supplying value to the economy. People just losing their entire life savings, right? 1%, such a massive number. You would think, or at least I would think, that it would be a much, much, much greater number. 50%, 60%, 70% would have the right insurance. No. A lot of people right now are underinsuring, and I think that trend's only going to continue as we start to step into this affordability crisis this year. People are going to start discounting their policies, pulling away coverage, doing whatever they have to do to try to make it. But look at this. State Farm, they reported a loss of $12.47 billion for 2023. It's a big number, right? That's just the first 9 months of 2023. You have all these insurance companies issuing total losses recorded as $100 billion. So what do insurance companies do when they have to absorb all these situations? Like, for example, in Florida, they had Hurricane Lee, they had the Fort Myers disaster, they had, Fort Lauderdale flooding, they had all of these problems. I mean, you had the fires in Canada and fires in California as well. They had fires everywhere. They had all these problems. What are they going to do? They're taking all these losses, absorbing it, and they're going to push it back onto every single property owner that needs insurance. That's what they're going to do. They're not just going to isolate their losses. They're going to push this out nationally. And so you're already starting to see this right now. Buying a home and auto insurance is becoming impossible. Wall Street Journal. Huge losses from natural disasters prompt industry to jack up prices and pull back from some markets' worst possible scenario for consumers. I mean, look at this. Buying home and auto insurance is becoming impossible. U.S. catastrophe exposed insurance rates up to 50%. 50%. Progressive, State Farm, Berkshire, Liberty Mutual. These are the big companies that are in Maine, that are also in nearly every other state. What are these companies going to start to do this year? Well, this is what I think they're going to start to do. So presently, 99% of Americans cannot afford to buy a home in 2023. 99%, right? So it's just the top 1% type of market. But many Americans say, hey, my home's worth $500,000. My home's worth $700,000 or $300,000, whatever your market is. Many people think that's what my home is actually worth because they go on Zillow and they see what other properties are listed for and they immediately assume they have this amount of equity in their property. But when you look at what's actually happening behind the scenes, you will see that a lot of these properties are nowhere near their true value. And here's what I mean by this. So mortgage rates, if you have an average credit score in America, which is a 698, you're looking at about 7.5%. 7.5%. But let's go low end. Let's say, for example, your credit score is 760, right? Or 750. You're somewhere around the 7% range. And you want to buy a $500,000 home. You want to put 6% down, which is the average down payment in America, which is $30,000. Your monthly mortgage cost would be $4,000 every single month if your homeowner's insurance is $1,687, which is the average. This is the national average. So if you live in Florida or you live in certain pockets of Texas or anywhere where insurance is a little bit higher, in Florida it's $6,500 a year is the average, right? So going as the national average here, $4,000 a month. So you basically have to make $140,000, $150,000 a year to buy a $500,000 home, which is not some luxury, beautiful mansion. The average home in America is $429,000. So at $429,000, it's $3,500 a month, right? And you have to put $25,000 down. But here's the kicker on this. So right now, rising home inventory, Bright MLS forecasts existing home sales reach 4.6 million in 2024, up from an expected 4.1 million in 2023. And inventory to increase by approximately 8% by the end of the year. Meanwhile, chronically low resale inventory receded 1.7%, leaving existing home stock at a scan of 3.5%. So they believe that home inventory is going to increase 4.6%, but only the top 1% can afford to buy. Who's going to absorb all this inventory? It's a big question. Who's going to absorb the inventory? What I think is going to happen is this. Rents are going to continue to fall. We're going to walk into an affordability problem. We're already in it. But people are going to start, even homeowners, start looking at the rising insurance, rising taxes, rising cost of being a homeowner, saying, you know what? I know I got a good mortgage, I know, but I just can't afford the upkeep. I can't afford the taxes and insurance. I can't afford everything. I need to downsize, maybe just for the time being. Maybe I'll go rent. I'll go take my cost and, I'll reduce my monthly cost, 50% or 40%, and I'll go rent for a little bit and not have to pay insurance and all the expenses associated with being a homeowner. And that's what's happening right now. Residential rents in the U.S. declined for the third straight month. The rental market's downward slide, 5 months. This is for 5 straight months. This is October, right? 5 days ago, rents in America finally dropped below $2,000. Who's going to opt in for going to spend twice the amount for housing? If you're renting for $4,000 or for $2,000, and you're going to go buy for $4,000. Who's going to want to do that? Not many people. If you want to go from $2,000 to $2,500, $2,000 to $3,000, maybe if you're looking for the tax benefits and you want to be a homeowner, sure. But not many people are going to opt in for paying twice. What I think is going to happen is a lot more inventory is going to hit this market as insurance and taxes rise this year, and they're going to see that it's going to be a race to the bottom. It's going to be a race to the bottom. U.S. rent drops for the third straight month. 6 days ago. Start looking at all these situations all across the first page. Everyone is just talking about 50-year high in apartment construction and rents falling. But here's where things are going to start to get really interesting. So they predict right now, IMF warns that AI to hit almost 40% of jobs worldwide, worse than overall inequality. This came out today. So this is the big question. If we're going to step into a job market where rents, or where rather wages, are going to start to soften, what are people going to do? Right? They're going to be forced to downsize. They're going to be forced to downsize. This is where the American housing market, the American economy starts to get rug pulled. This is going to be a market for the top 5%. And the next year, next 2 years, it's going to be a race to get into the top 5%. Because what are people going to do that are going to be losing their jobs? Fire sale and assets. That's what they're going to do. Interestingly, they predict here that most of this, the IMF noted that 60% of jobs could be impacted by AI in high-income nations. Germany, U.S., London, all over, right? All the high-income nations. What's going to happen? A lot of these Latin American countries, Mexico, a lot of these South American countries, they're going to start to flourish. Why? They have a lower cost of living, lower wages. They're going to be impacted less. So what I believe is going to happen is I think we're going to start to see a lot of change happening, to say the very least, here in America. And I think this is going to happen so quickly, and I think a lot of people underestimate just how big this wealth inequality is actually going to get. This situation with generative AI and technology over the next couple of years, it's going to be so big. They predict that 85 million jobs will be lost just by next year, 2025. Now, many people might say, hey, John, that's not going to happen. It's not going to happen. Pay very close attention to where the American consumer really is. Almost half of Americans have used buy now, pay later apps, and 1 in 5 rely on such apps to buy groceries. Think about that. 20% of American consumers are financing bread, chicken, eggs, milk, right? I mean, is this a healthy economy? right? In 2008, delinquencies are on credit cards are about 6.5%. Now for subprime borrowers, delinquencies on credit cards are over 9%. That's for subprime. But if you're a high credit score type of candidate, really responsible, never late on anything, still Americans are at a 10-year. This is the highest in a decade. It's the highest in a decade. And what they go on to say is that right now, a January 8th report from LendingTree found that the largest 100 metros, 29.6% of Americans are behind on at least one debt payment between July and September 30th, 2023, and just over 27% of consumers had payments delinquent by 90 days or more. So when you see this, and then you see, okay, people are desperate for credit, they need money, they're really kind of pushed into a corner, and then you see mortgage refinancing jump 19%. You have to ask yourself, how can the U.S. economy, how can the U.S. housing market adjust as they continue to increase rates for insurance, increase property taxes, increasing all of the costs associated with home ownership? I don't think it can. I don't think we have a buyer's market that, a pool of buyers that are going to be able to absorb this inventory. And I think that what's going to happen are the desperate sellers, they're going to be reducing their prices, and it's going to reduce the comps and values of these properties. We're going to start seeing a lot more price reductions and a lot more desperation in the housing market. But I think inside of this, a ton of opportunity. That's it. At the end of the day, it's going to be a ton of opportunity for those that have cash, those that have credit, those that have a game plan, those that are really forward thinking. People like that are going to do extremely well. But there's going to be a lot of people that are going to say, never going to happen. Never going to happen. The housing market's resilient. Everyone has equity, in their homes. Everyone's going to be able to weather the storm. Everything's going to be fine. Look, you think we're going back to 2018, 2019 type of world? I don't see it. I think every single year it's getting crazier and crazier since then. So I believe that it's only going to get harder for most. So position yourself so you can go out there and really acquire a lot of assets, put yourself in a really strong position. If you do that, you'll thank yourself forever, and so will your family. What do you think about this entire situation? Drop below, hit the like button, add me on IG, and if you'd like to fix your credit, we'd love to help you. We really would. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for tomorrow, and I'll catch you in the next video.